If inflation is falling and Fed funds stay here, real interest rates are getting tighter. So the Fed is unwittingly causing monetary policy to tighten because as interest rate expectations fall, and the UMich survey showed a drop on Friday, they're actually unleashing more tightening into the economy. So I think it is a real problem. I think that the reason it's felt so bad for folks is number one, I think there's three things.
Tom Lee begins by acknowledging an uncomfortable truth. No matter how long someone has been in markets, price still controls emotion. When prices fall, confidence evaporates, fear spikes, people become angry, anxious, and reactive, and strategic thinking is replaced by primal reflex. According to Lee, this emotional distortion is exactly what we're seeing now. Despite years of experience, investors struggle to detach emotionally when portfolios are under pressure, and this is especially true in crypto, a market known for extreme volatility.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
No matter how long somebody has been in markets, and that's whether in crypto or in equities, price still determines emotion. So when prices are declining, nobody's feeling very confident. So there's a lot of anxiety, a lot of anger and emotions and second guessing. And I think too many people make, I think, what I'd call reflexive decisions so they're using sort of primal thinking instead of strategic thinking, but that always happens during declines. I think that the reason it's felt so bad for folks is number one, I think there's three things, many more than three, but number one, I think in the back of people's minds, they've been thinking there's a 4-year cycle. And so, as you know, when everyone carries a hammer, then all they see is nails. So in their minds, everything that's happening is confirming that we're in a 4-year cycle. And I've had a lot of people show me that chart, the 391 days, right? 1,064 days of gains and then 364 days of declines. And that's number one. So it's the pattern recognition in people's minds. I think the second is, as much as people have been excited about AI and quantum, I think quantum is kind of viewed as quantum progress is seen as a threat to crypto. Or crypto hasn't figured out whether it's good or bad for crypto. Because as you know, there's a lot of people talking about the encryption risk for Bitcoin and other cryptos because of quantum. And the third reason I think it's felt worse, Frank, is maybe the price hasn't really reflected the mass liquidations that have taken place. You know, I think is maybe the reality, is that Bitcoin and Ethereum have held up really well, but I think there's many stories of people's accounts being wiped out. So I think that that's not reflected in the price. The Fed is the most important entity in the world. I mean, as you know, they say bull markets don't die of old age, they get ended by the Fed, right? So maybe the Fed pretty much drives what happens to risk assets and then ultimately to the business cycle. And this current Fed is not operating with the clarity that most investors want. And part of it has to do with, there's of course been a very visible dispute between the White House and monetary policy, and even questions of Fed independence. And as a consequence, Powell, I think, has done a really good job of navigating this. But keep in mind, he is the Fed chair, but then he has to corral all the other voting members, of the committee, the FOMC. And each of these members represents, these voting members represents thousands of people that work for them. So the Fed is, 30,000, I think maybe 20 or 30,000 total employees. And as you know, they're concerned about their existential independence. So I think every voting member feels that pressure from everybody that works for them, that if they cut rates, they're just bowing to the White House. And whether or not they claim to be independent, they can't escape that pressure. And I think that comes through in every comment. Like what you just cited, someone from Boston, the Boston Fed, saying they don't see the need for a cut. Objectively, that's dead wrong, because the bond market, the Fed funds implied futures, or even 1-year forward inflation, say there isn't really an inflation problem, which means if inflation is falling and Fed funds stay here, real interest rates are getting tighter. So the Fed is unwittingly causing monetary policy to tighten, because as interest rate expectations fall, and the UMich survey showed a drop on Friday, they're actually unleashing more tightening into the economy. So I think it is a real problem. But of course, the Fed can course correct really quickly. But over the weekend, people read the paper, like you said, and price makes people drive sentiment. So not only do people panic over the weekend, but as you know, outside the US, everyone looks at this, and if they're getting concerned about monetary policy and they own a lot of crypto, they're just going to sell their crypto. If we look at risk assets in general, I think people become overly tied to a narrative and simplicity, thinking that explains markets. Like, for instance, I think too many people that do equities think, hey, a company has great earnings, the stock should go up. Or they'll be like, inflation's high, so stocks should go down. Or, the ISM's below 50, so we should be in a bear market. But as many people who try to understand macro know that those things rarely explain what stocks do. And so you're right. So as crypto starts to have more macro and institutional investors, and then be tied to money flows, the price of crypto won't always make sense, but if someone, if I was just to make some casual observations, since late October, a lot of the things that have corrected in risk markets have been the things that did really well this year. So like the AI stocks have sold off, the nuclear names have sold off, the quantum names. So these are, they've been very popular with hedge funds and retail investors. And they've had what you'd say is their price has outperformed the expectations around earnings growth. So basically the risk premia has fallen, or their multiples have gone up. So that's what's derated. And if someone asks me why things have derated, I think it actually is just possibly a couple of things. One is the Fed isn't really dovish. I mean, the Fed, people haven't decided, and the Fed still hasn't decided if we're in a disinflation cycle.
Yeah.
And if we are, they should be cutting. But as you know, every Fed meeting is a coin toss. I mean, look at in the last week, the odds of a December cut had dropped. They went from 70%, dropped to 30, and are back to 67. I mean, that's for Fed cutting in December, and this close to December. The fact that probabilities have moved that much show you that there is so much uncertainty around monetary policy. And as you just kind of described, the current White House and the president is very divisive because there are those who didn't vote for him. And for whatever reason, this White House has really become a lightning rod for divisive and dissent. I mean, there was even last week some military members suggesting they should disobey orders from their commanders. I mean, that that's very politically divided. And the third is there probably was leverage being built up in the system. I mean, in equities and in crypto. And so we're just seeing a leverage reset. I don't know if that really helps, but I mean, I'd say that those are contributing to like why crypto probably isn't performing as well as we think, because you're exactly right. There's so much building being done. And actually we know that there is so much being built by Wall Street wanting to actually embrace and build on the blockchain. So, does that mean crypto is broken, or are we in a period of time where the fundamentals are doing better than the equities? I mean, I think that's where we are right now.
Lee challenges a common error in crypto modeling, the assumption that systems and incentives stay static. He uses Facebook's early mobile strategy as an analogy. At first, analysts believed Facebook couldn't monetize mobile users because early usage was free and ad revenue seemed limited. They were spectacularly wrong. Similarly, L2 networks growing faster than L1 fees is not necessarily bearish. Network effects may be far more valuable over time. Value accrual can be delayed but exponential. Scale can transform economics in unpredictable ways. Ethereum and L2 ecosystems may follow a similar path, where early monetization looks weak but long-term value becomes massive.
Yeah, DATs have been part of the 2025 narrative. And I think that there has been, as the number of DATs have grown, and we've talked about this, not all DATs are created equal, because a proper DAT, a proper digital asset treasury, really needs to serve as a bridge, right? Because it's a bridge between the institutional or public equity world and the crypto world. And a DAT there shouldn't just represent passive exposure to crypto. It should really serve a function. And so MicroStrategy, as you know, is really the blue chip and the flagship and the first crypto treasury. But what they've done is they've accumulated a lot of Bitcoin, and then they've essentially turned it into a type of financial institution where they're productizing their Bitcoin holdings and offering yield products, and in a way that takes advantage of the characteristics of Bitcoin, which is the volatility of Bitcoin, and it's also stable store of value, right? I mean, basically Bitcoin over the long run is going to go up in value. So they have an asset that they know is appreciating. And then, as you know, a lot of other crypto treasuries followed suit, a lot of Bitcoin treasuries, but many of them didn't raise capital in a way that created accretion for their shareholders, or they had expense structures that were expensive and less attractive than an ETF, or they didn't really have a clearly defined function. So I think that this is the shakeout that happens, but that's kind of capitalism. I mean, since 1970, 44,000 stocks have gone public. Okay. Now we know there aren't 44,000 companies in the stock market today. The reason being, and we've looked at this, 90% of stocks fall 90% once they go public. And of those, only half of them ever recover. So basically, most companies that ever go public are failed equities. That's the reality. That, like, when someone says like SPACs came and went and only 5% survived, that's pretty true of IPOs. That's pretty true of spinoffs. That's basically pretty much true of any business. We know that in, like, for instance, in restaurants, 95% of restaurants fail after 3 years. So does that mean every restaurant is a bad business? No, it just shows you the businesses that survive must be really good businesses. And so in my opinion, what's happening with DATs is going to prove that the ones that survive and prevail or raise capital or are big are probably far better businesses than people realize, because they survived capitalism. You can't, just think about the premise. Someone says, "Oh, I'm just going to create a crypto debt, and my stock's going to go to the moon." I mean, it's kind of absurd, right? Because an equity investor is not just buying a ticker. They have analysts. These guys talk to the companies. They talk to the chairman. They understand the strategy, and then they want to know if their stock price is aligned with the vision. So I wouldn't expect most stats to survive. I think that there's a flaw that most people make when I see crypto projects and people talk about crypto tokenomics or crypto economies or whatever economic model, which is that they have static assumptions. They'll say, "Oh, look, Tom, there's all this stable coin growth and there's all these L2s, but they're not generating fees for the L1, so therefore the L1 doesn't accrue value." That is the same as someone saying in Facebook, okay, when Facebook launched mobile, and they said, "Well, Facebook, you're not charging any money for people to actually do mobile. You're actually just, it was free on the desktop, it's free on the mobile. And maybe you can sell 10% more ads on mobile, so therefore it's not really beneficial to Facebook." Do you realize how wrong people were about that assumption, right? Because basically Facebook is a UGI company. So the more people that use it, the more valuable it became as a platform for advertising. And of course, the network effects kicked in. And then today, Facebook dominates all the advertising business, but that was not evident in 2007. L2s, it may make sense, especially on Ethereum, to let the L2s grow, create a huge ecosystem, and not charge direct proportionate gas fees. Because if this is where everything is going to be built, then the L2 is going to accrue significant value.
Tom Lee's analysis gives us a powerful and much-needed reminder: markets are not broken, psychology is. Price-driven emotion, Fed uncertainty, quantum confusion, and hidden liquidations all combine to create an environment where investors feel worse than the charts suggest. But beneath the surface, development continues. Institutional adoption is rising, and blockchain financial infrastructure is expanding rapidly. History shows that cycles of fear, uncertainty, and forced deleveraging always precede major periods of growth, especially in emerging technologies. If Lee is correct, we may be in the late stages of that fear cycle right now. As always, remember, emotions fade, fundamentals persist, and innovation compounds.